It is the 15th of May 2023. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 or SPX and also Bitcoin. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. So let's start with a discussion of the S&P 500, or we are looking at SPX prices here, which are of course closely related to the S&P 500 cash index. And this is the situation that we have been looking at for several weeks. And I'm not going to zoom all the way back out again because I have been taking a slightly longer term view in recent market update videos, so I would encourage you to go back and look at those. We had, of course, an 18-month cycle trough, in my opinion, in October of last year. And at the time frame that we are looking at here, we had a 20-week cycle trough in the middle of March. There has been a question mark recently around the position of the 40-day cycle trough. I discussed that in last week's market update video, and we will be discussing that again in today's video because there is the possibility that the 40-day cycle trough occurred, as has been phased in this analysis, in the second week of April, and it is also still possible that the 40-day cycle trough actually occurred over here in the final week of April. As discussed in recent market update videos, I am not too bothered as to which of those is correct at the moment. And this, I think, helps to illustrate an important point about approaching trading financial markets on the basis of a Hurst cycles analysis. You do not need to achieve 100% certainty in your analysis before you can nevertheless gain a great deal of insight into what the markets are doing and make sensible trading decisions. That has been the theme, if you like, of the past two market update videos, and I'm going to be continuing that theme in today's discussion. The important thing about this analysis is that we are expecting price to come down into an 80-day cycle trough. As you can see, there is the nest of lows for that 80-day cycle trough in the third or final week of May. And so at present, that 80-day cycle trough is probably still a week or so ahead of us. I've added some bar counts, as you can see, to this chart. There have been 63 days since the 20-week cycle trough in the middle of March, the average length of an 80-day cycle discovered by Hurst 50 years ago. I do enjoy saying that because it is an extraordinary thing that these cycles continue to beat with a fairly regular rhythm. Of course, there is the principle of variation that Hurst defined, which explains that cycle wavelengths are constantly varying. They are dynamic. But we are able to perform an average calculation, of course, and the average of the 80-day cycle comes out to 68 days. Compare that to the recent wavelength, or the recent average wavelength, over the past 6 iterations of the 80-day cycle, and you will see that that has been an average wavelength of 60.5 days. And so as of today, we are approaching the average wavelength over multiple years that has been calculated at 68 days, and we are just a few days past the recent average wavelength. And so the time is right for this 80-day cycle trough to occur. As mentioned in a previous market update video, I think it might have been last week or possibly even the week before, the 80-day cycle circle at the foot of the chart was over here in about the middle of last week. And so is it possible that this over here is in fact the 80-day cycle trough? Those are the kinds of questions that we ask ourselves when looking at a Hurst cycles analysis. Now, usually when looking at a Hurst cycles analysis, the picture is a good deal clearer than what we are seeing at the moment. But that is why I thought it would be interesting to continue this discussion, because even when the picture is not clear, we can gain a great deal of insight into what is happening in the markets and develop some expectations of what we are expecting to happen next. So let's continue to consider this analysis with the 40-day cycle trough over here in the middle of April. cycle and ask ourselves what we are expecting. Let's first of all display the FLD. The FLD, or future line of demarcation, is my favorite cycle tool. It is a very simple line developed by Hurst 50 years ago, and it is simply the median price displaced to the right by the recent average wavelength divided by 2, and then we add 1 bar to displace that median price just a little further from price. And so taking a look at this FLD, we can see the sequence of interactions which I have labeled often recently, so I'm going to move through this fairly quickly. There's our A category interaction. According to this analysis, this would be the B and C interaction pair, where price finds support at the level of the 20-day FLD at about the time of the 20-day cycle trough. As you can see, in this particular market there was a good deal of bullishness, and price didn't find support at the level of the FLD, it found support above the level of the FLD. Not entirely unusual in a bullish market. The D category interaction is usually where price would cross down below the FLD, but in this case price found support at the level of the FLD. We would still label that a D category interaction because it is the interaction that occurs just before the 40-day cycle trough in the analysis. Then the E category interaction is where price usually crosses up above the FLD, or in this case simply bounced up and away from the FLD following the 40-day cycle trough. Our next interaction is the F category interaction, which on this analysis would be labeled over here as price dropped down below the level of the 20-day FLD. That interaction achieved its target fairly accurately, raising questions, as discussed in previous market update videos, as to whether this could possibly have been the 40-day cycle trough, because that kind of behavior is what we would usually see in a D category interaction as price moved down below the 20-day FLD towards the 40-day cycle trough. When price comes up and finds resistance at the level of the 20-day FLD, we would label that a G category interaction, followed by an H category interaction as price drops down below the FLD, or drops down away from resistance provided by the FLD into the 80-day cycle trough, raising the question as to whether this could possibly be the 80-day cycle trough. As mentioned in last week's market update, I believe it was, that would be a very early 80-day cycle at a number of bars, only 52 since the 20-week cycle trough in the middle of March. It is not impossibly early, and the fact that it is not impossibly early is indicated on this chart by this whisker, which is the line extending to the left of the 80-day cycle circle. That whisker represents the reasonable range of time in which an 80-day cycle trough could occur. And so it is just possible that the 80-day cycle trough has already occurred, and occurred in the first few days of May. This would have been a very short 80-day cycle at only 52 days long. What is more likely is, as discussed in a recent market update video, that this is in fact a 20-day cycle trough, and so we are seeing a final bounce out of the 20-day cycle trough, and we are looking at one more move down into the 80-day cycle trough. That is still my preferred opinion. In other words, I think this was a 20-day cycle trough that occurred over here. Price came back up, found approximate resistance again at the FLD, meaning that we would have experienced a double GH category interaction. Not very unusual. We do often see double GH category interactions. So at the moment, according to this analysis, what I would expect to happen is that price drops down below the level of the 20-day FLD on its way down to the 80-day cycle trough. That could give us a good short trading opportunity. However, we need to bear in mind the fact that the market has been fairly bullish. It's fairly obvious. You can draw some very simple cycle shapes over here, and you can see that the market has of course been bullish. Today's price action has been interesting, and I should point out that I am recording this video before the markets open in the US, and so this is after hour trading or before hour trading on Sunday night that we are seeing in this little bit of a bar on Monday. And an interesting thing has happened over the weekend, as often does happen. As you can see, price was in fact pretty much below the level of the 20-day FLD throughout last week, and it has crossed by default, as it were, on Monday morning or on overnight trading on Sunday. by virtue of the fact that the FLD itself is of course at a lower level, and so price has not actually done anything. It has simply skipped the weekend and finds itself above the 20-day FLD. That's an interesting detail that you will often experience if your FLDs are correctly plotted on charts that include gaps over the weekends. I've discussed that in previous market update videos. I don't think I need to dwell on it here. So my expectation is that of course price will drop down below the 20-day FLD on its way down to the 80-day cycle trough. But now let's play devil's advocate for a moment. What is going to happen if this was indeed the 80-day cycle trough that occurred in early May? I mentioned that that was a possibility. Well, in that case, we turn our attention to this bar count. You can see there have been 11 days since the possible 80-day cycle trough that occurred at the beginning of May. What would we expect to happen if this was an 80-day cycle trough? Let me draw a diamond below it, and let's assume for the moment that that was an 80-day cycle trough. The first thing that we would expect to happen in terms of interaction between price and the FLD is that price would cross above the FLD in what we would label as an A category interaction. That price cross above the FLD, I believe, did just about reach its target over there. Price has now, by default, crossed up above the FLD again in the move that it did over the weekend. And so we actually have two price crosses, which would mean that we should adjust our target to the upside, and so we now have a slightly higher target as a result of that double price cross. And so we could still be in the midst of an A category interaction. What are we expecting next in terms of price and the FLD at this point? If this was an A category interaction that occurred about 10 days ago, then what we would expect next is for price to find support at the level of the 20-day FLD at about the time that the first 20-day cycle trough forms after this potential 80-day cycle trough that we are considering in the beginning of May. Now, it's very simple to work out where that next 20-day cycle trough could be. You can see we have an indication using these circles over here, and so that is when we would expect the next 20-day cycle trough to occur. Of course, if this was an 80-day cycle trough that occurred here, then the 20-day cycle wavelength must be shorter than it is indicated at the foot of this chart. I'll let you work out the reasons for that yourself, but suffice to say for now that if the 80-day cycle trough has already come in, then the 20-day cycle must be beating with a shorter wavelength than the wavelength indicated on this chart, meaning that we would expect the first 20-day cycle trough following this potential, and I should say again fairly unlikely 80-day cycle trough at the beginning of May. We would expect it a bit earlier than indicated by this nest of lows at the foot of the chart, meaning that we would expect the 20-day cycle trough to occur sometime this week. That means that this line, the FLD, is going to be an extremely important line to watch this week, because this line is going to provide us with an answer as to what is happening in this market. If the 20-day FLD provides support, we are going to have to take more seriously the possibility that the 80-day cycle trough did occur in the first few days of May. If, however, price does cross down below the FLD, which is still, in my opinion, the most likely scenario, then we would be looking at price moving down into the 80-day cycle trough, expected sometime probably early next week or possibly even slightly later. Now let me display another FLD on this chart, and I displayed this FLD in last week's video. I'm not going to zoom out to the weekly chart because I thought it would be interesting to take a look at the 80-day cycle FLD on a daily chart today. Usually we would consider it on a weekly chart. I did that last week, so go back and take a look at last week's video to make sure that you understand some of the subtleties of these FLDs and the time frames that you should be watching them. The interesting thing about the 80-day FLD is that at the moment, according to the sequence of interactions between price and the 80-day FLD, we would expect price to drop down below the 80-day FLD. Now, it doesn't need to do that this week. So the 80-day FLD we consider on a slightly wider time frame, of course, because it is based on a larger wavelength cycle. But as indicated in last week's video, video, we are expecting price to cross down below the 80-day FLD on its way down to this 40-week cycle trough. You can see the circle for the 40-week cycle trough over here on the right of the chart, but of course that 40-week cycle will be synchronous with the next 80-day cycle. So we have about 10 weeks to go until that 40-week cycle is expected, and sometime in that 10 weeks we are expecting price to cross down below the 80-day FLD. What is of particular interest to me is that on a daily chart and also on a weekly chart, let me just change the time frame here to a weekly chart. There it is on the weekly chart. You can see price has found support at the level of that FLD. In other words, it hasn't actually crossed down below it. Now, the whole idea of price finding support at the level of an FLD is of course something that we anticipate in our sequence of interactions that we track between price and the FLD. But it is also something that you will often see happening at around about the time of the 80-day cycle forming in the market. In other words, at about the time that the 80-day cycle trough forms in the market, you will often see price finding support at the level of the FLD. How does what I have just said match with the idea that we are expecting price to cross down below the 80-day cycle FLD? The reason that I can make both statements and they can both be true is that on the way up we expect price to find support at the level of the cycle FLD at about the time that that cycle trough forms in the market. So let me just explain this in a little detail here. I've already marked the interactions between price and the 20-day FLD, and I've pointed out that the B and C category interactions are where price finds support at the level of the FLD at the time that that trough forms. That's on the way up. Now, on the way down, sometimes we will also find price temporarily finding support at the level of the FLD before it crosses down. The interesting thing about the downward path is we label that downward path, as I have already done, F and then GH, and sometimes of course we get a double GH. I haven't written that very clearly, but sometimes we get a double GH. And where is the 20-day cycle trough in that sequence? And this is the interesting point about the downward section of the interactions between price and the FLD, and that is that there is no absolute guideline in terms of when we expect the 20-day cycle trough on the way down. So it could be there, or it could be here, or in fact it could occur even later. So in other words, potentially the 20-day cycle trough could even have been down there. I hope that makes sense to you. We always speak about the BC category interactions occurring at about the time of the 20-day cycle trough, but in fact I never speak about where the 20-day cycle trough should occur between the E, F, G and H category interactions, because there is no clear rule of thumb, and it depends on whether we are looking at a bullish cycle or a bearish cycle where that 20-day cycle trough will form. And so the same thing is true with the 80-day cycle. Here we have an 80-day cycle FLD, and we are, in terms of our sequence of interactions, expecting price to cross down below the 80-day FLD. However, it is also possible that at about the time of the 80-day cycle trough, price will find support at the level of the 80-day cycle FLD, come up, make another high, and then cross down below that 80-day FLD. I hope that was an interesting little diversion into understanding how these FLDs work. I have mentioned already that there is a question mark surrounding the position of this 40-day cycle trough. When I have a question mark around the position of a cycle trough, particularly one which is affecting my trading decisions, I will often like to watch both possibilities on two different charts. So here is a chart where we are considering the possibility that the 40-day cycle trough occurred over here in the last week of April. You can see these pin symbols indicating that I have influenced this analysis to consider this possibility. The interesting thing about this analysis is that the FLDs are in a very similar position. If we plot both the 80-day and the 20-day FLDs on the chart, you can see that they are pretty much in exactly the same position. Let's focus for now on the 20-day FLD because there is nothing to add with regard to the 80-day FLD, and you can see that the sequence of interactions here is of course very similar, but with a few differences. to the other analysis. There is our A category interaction, which achieved its target as would be expected. Our B and C category interaction occurred at the time of the 20-day cycle trough, which is in a different position in this analysis, and so that is our B and C category interaction pair. It didn't find support at the level of the FLD, but way above the FLD. Then, of course, price found support at the level of the FLD around over here. Here is the D category interaction. As price came down below the FLD, it achieved its target over here. This is our E category interaction, which produced a very disappointing move up again to the second peak possibly the second peak in the 80-day cycle. There was the first one and there was the second one. Then price came down again. That would have been our F category interaction. Here is our G, and we again get a double GH category interaction occurring over here. This is our next G category interaction. So again, we are expecting exactly the same thing according to this analysis. I show you this chart because it tells exactly the same story, even though the 40-day cycle trough is in a different position. And that explains again why it is not always important to resolve every single detail in your analysis before being able to gain insight into what the markets are doing. Let's take a look at Bitcoin, and I thought I would take a step back. This is a weekly chart of Bitcoin, and we had an interesting question, I think it was on last week's video or perhaps the week before, questioning the possibility that this was the 18-month cycle peak. Well, not questioning the possibility that was, because in the analysis, as you can see, that recent peak in April has been phased as a peak of the 18-month cycle. The question that was asked, or the comment that was made, is whether we would expect such a not disappointing, but such a small move down out of an 18-month cycle peak, or would we expect a much stronger move down from that 18-month cycle peak. And in order to understand the context of that comment or that question, you should go back and take a look at, I think it was last week's market update, in which I discussed Bitcoin. And of course, the answer to why we might expect a very disappointing move down out of the 18-month cycle peak has to do with the fact that this is probably a very high magnitude cycle trough of at least 54-month magnitude. Very high magnitude cycle trough, possibly even a 9-year cycle trough that formed over there in November of last year. I thought it would be interesting to take a look at the weekly chart here, because in fact we should question whether this is actually the 18-month cycle peak or not. So first of all, let's consider the bigger picture with Bitcoin. Bitcoin is a fascinating instrument to analyze because it seems to respond to cycles that are synchronized at their troughs, as well as responding to cycles that are synchronized at their peaks. It is very rare that we get an instrument that works with a trough synchronized analysis and also a peak synchronized analysis, and Bitcoin has been doing that over many years. If we measure the number of days in between these two 54-month cycle troughs, you can see that gives us a wavelength of 47.1 months, which is fairly short for a 54-month cycle. But the interesting thing is that it matches very closely the recent wavelength of that 54-month cycle in the peak analysis, which you can see was 46.6 months as opposed to 47.1 months. And so we have a very interesting situation where these cycle wavelengths seem to be very closely matched between the trough analysis and the peak analysis. But now let's zoom in over here and ask ourselves whether this really is the 18-month cycle peak. If we measure the number of days since that peak in November of 2021, you can see there have been 17 months or 517 days, 515 days. Of course, I'm looking at a weekly chart here, so it's not a very accurate bar count, but that's good enough for now. That number of days is about 30 days short of the average 18-month cycle wavelength discovered by Hurst 50 years ago. But it is a very good match for the recent wavelength as calculated on the basis of this analysis. However, is that really the 18-month cycle peak? let's answer that question by taking a look at the shorter cycle peaks that have been found in this analysis, in particular the 40-week and the 20-week cycle peaks. So what we would do when considering an analysis in this way is we measure the number of bars to each one of those peaks and consider how likely it is that that is a correct placement for that cycle peak. You can see 139 days elapsed from the peak in November of 2021 to that 20-week cycle peak at the end of March last year. 136 days is the average length discovered by Hurst many years ago for the 20-week cycle, and so at 139 days, that is a very likely and very good position for the 20-week cycle peak. The 40-week cycle peak that occurred over here at 279 days since the very prominent peak in November of 2021 is again a very good position for that 40-week cycle peak, because the average length of a 40-week cycle is considered to be 272 days, and so that was only about a week late for the 40-week cycle peak. However, if we zoom in, and let me clear those pen marks, if we zoom in on what has happened since that 40-week cycle peak, you can see that the analysis falls apart a little bit. Perhaps I shouldn't say falls apart, but the length of 83 days for this 20-week cycle is very questionable. That 20-week cycle would be much better positioned, in my opinion, over here in the third week of December of 2022. I should remind you what was happening at around about this time when it came to Bitcoin. There was the FTX scandal that occurred in November of last year, and that caused a lot of volatility. And so analysis round about that time is quite difficult because of the increased volatility as a result of those news events. And so that 20-week cycle is certainly a slightly questionable position. But if we consider this peak over here, you can see 168 days is really very long for a 20-week cycle. So it is quite likely that the 20-week cycle, in fact, only occurred over there. But now if we measure forward from that alternate position for the 20-week cycle, you can see this fairly prominent peak that occurred in about the middle of April is at 118 days, 16.9 weeks, which is fairly close to the average length of 136 days. So if we measure forward to the current day, you can see there have been 152 days. If price is going to come up and form another peak, it would then be a fairly late peak. And so for those reasons, it is very likely that the 18-month cycle peak did occur in April of this year. But because of a few question marks around this analysis, it is possible that the 18-month cycle peak still lies ahead of us. However, in my opinion, it is likely that the 18-month cycle peak did occur, and if we change this chart to a daily chart and zoom in a little bit to reveal recent price action, you can see that price has been dropping out of this 18-month cycle peak and has been coming down into an 80-day cycle trough over here, and a very possible trough formed in that market over there, in which case price is now bouncing out of an 80-day cycle trough. And so back to the original question, is it possible that the first move down following an 18-month cycle peak, which sounds like a pretty big important peak, is it possible that it could be such a small move down? There is, of course, the zigzag shape of that move down. Yes, it is certainly possible, because we must bear in mind the fact that this trough that formed at the end of last year was possibly a trough of even greater magnitude than 54 months, in which case we certainly have a lot of bullish pressure, as has been shown by the cycle shapes that we have experienced since the formation of that trough. And so the bullish pressure is still alive and well in Bitcoin, in my opinion, even if the 18-month cycle peak did form in the middle of April. I do hope you found this market update useful and interesting. If you have any questions, please join us on our Discord server or comment below this video. I look forward to hearing from you.